Oh my goodness, what a week out there. Welcome back to Stock Market Weekly. I am your host, Evan Medeiros. This is the show where we break down everything going on across financial markets through the lens of technical analysis, and we have lots to dive into this week, so let's not waste any time. Let's get into it here. Let's rewind to Wednesday. Feels like ages ago, but just a few days earlier, we had the Fed out, Jerome Powell, sort of giving its press conference, its latest decisions on interest rates, and Jerome Powell basically set the stage for a September rate cut, leaving rates unchanged this week, and that was pretty much market expectations. However, when we flash forward to some of the data we got out on Friday, specifically the jobs report, we had the jobs report come in much weaker, but really it was unemployment ticking up, and that caused the market to get into a bit of a panic here on a potential recession that could be incoming here, fearing that Powell maybe waited too long here. September was too long, and maybe it should have been the rate cut on Wednesday. So lots of folks kind of speculating where if we got this jobs data out before the Fed meeting, maybe we would have gotten a rate cut this week. And so we've got this sort of SOM rule that is triggered, which is basically this recessionary indicator, which looks at the unemployment rate and sort of predicts recessions, I guess, with a high degree of accuracy. I haven't really dug into the statistics of it, but clearly the market is in a bit of a panic mode here. We've got the dollar and rates seeing some of the biggest moves we've seen for a single day session in quite some time. We had the VIX jumping to 30 almost, or just about 30, almost got there. One of the worst days for Intel company earnings, just generally, I mean, I shouldn't say they're all bad because they've been all over the place, but it was a busy week of earnings. Intel was a total bomb here coming in with this economic data on Friday. So we've got plenty to comb through here in terms of data, charts, and where the heck we are in this roadmap of a correction. Stick around. All right, we're back. We've got some charts in front of us. TC2000 as a charting platform we're using in this video. It's a platform we support here at The Trade Risk. Check out our website, thetraderisk.com. We've got all kinds of goodies, downloads available for TC2000. If you don't see what you're looking for, reach out to us, let us know what it is, and we might be able to build it custom for you. All right, so let's get into the numbers here. Red across the board, basically 2 to 3% down for the S&P, Nasdaq, and Dow. But take a look here at the Russell. Just when the Russell was starting to reach some of that escape velocity and start to get that breakout, it comes really reversing hard in the other direction. Almost 7% down this week for the Russell 2000. You clearly saw where some of that hot momentum money was lingering, and a lot of it came out. Now, 1 month returns, Russell 2000 still hanging in there, right, as the best house in the neighborhood, but doesn't mean a whole lot when your account value lost 6.82% this week. If we take a look at volatility down here, we're going out at some of the highest levels we've seen on a weekly closing basis for volatility going back almost 2 years. So we've got the VIX up at 23.64, and we got Nasdaq vol almost at 28. So some big readings out there, some fear that certainly escalated on the latter half of this week. Now, let's take a look at sectors. It wasn't all red across the board, even though the indices were. If we take a look underneath the hood here, we do have that defensive tone to the market. So utilities benefiting from this huge move that we saw in the yield curve. We also see real estate sector doing well, benefiting off of those knee-jerk reactions and yields as well. Communication services was also green. Same with consumer staples and healthcare. On the downside, technology continues to be the tough spot to be in this market. Technology has been in this sharp drawdown. Take a look at the 1 month returns for tech. It's down 12%. Nothing is close to that. Basically, consumer discretionary, thanks mostly to Amazon, I would say, on the report this week, is down 6% over the last month. But most things are either green or slightly negative. And energy also minus 4%. Crude oil getting hit pretty hard this week, the commodity itself. Now, if we take a look here at our sector trends, we definitely see a little bit of wobble here going on across some of this improvement in market breadth that we were tracking for the last couple of weeks. We didn't see total rollovers yet. So again, this is a custom indicator. It's called our Smart Trend Filter Indicator. It's available for TC2000, of course, but also for TradingView if you want to get it on your own platform. You can see that on these daily charts, you're starting to get these turn downs here, these yellow dots getting printed. If the weakness continues next week, we would expect more sell signals to be produced. The goal of this indicator is to sort of reduce whipsaw and to wait for those clean, clear signals on trend changes. And we'll see early next week if we start to get more of those sell signals produced. But it was a good run here for a little bit of time in things like financials and discretionary and industrials and utilities. Some of those are still hanging in there, but you're clearly seeing a little bit of deterioration this week in terms of market breadth. Speaking of market breadth, if we take a look here at our 52-week highs and 52-week lows, we do have something noticeable, a little bit different. Notice we still have, a decent amount of 52-week highs being made this week. It's clearly dried up. It's not at the pace or as high as we saw in the last couple of weeks. But notice we also do have a slight uptick here on Friday on the number of stocks hitting 52-week lows. The number is still relatively contained, but let's keep an eye on it. If we have another week like we just saw, then we would expect that this indicator is going to start to blow out in the other direction. That's exactly what we don't want to see if we are long-term bullish on the stock market. Basically, we're looking for contained, methodical corrections that rotate throughout the market, that don't leave the market into, say, fixed income or gold or other safety assets or money markets, right? We want to see rotation across the market, out of high beta, maybe into those lower beta, like we saw with utilities this week and consumer staples and healthcare. But we don't want to see a big flurry and uptick here of number of stocks hitting 52-week lows. So we're going to keep an eye on that. The ratio right now is to be expected, thinning out a little bit, and we'll see if there is that expansion in the other direction next week if this correction continues. Now, let's take a quick pit stop here. Investors Business Daily, they are a sponsor of this show. So thank you, IBD, for making this show possible. This is their top 10 on their IBD 50 list. You can see that there was some mixed performance this week. We had some good winners, mostly out of ALNY, TMDX, so this more kind of healthcare or defensive pharmaceutical sort of mixture of it. And then on the downside, we did have MIRM, MMYT, NSSC. Most of these companies not super familiar with, but some high single-digit losers there on this week's turbulence. So sign up for an IBD digital subscription. You can find a link in the description of the show. Support the show, support IBD with that link in the description of this video. Let's move along here to commodities, which had some mixed performance. Really, it was the metals, silver and gold doing well this week, and gold looking pretty nice on those longer term charts. We'll look at that in just a little bit. Copper was also up. Everything else was down though. Copper index, dollar index fell very sharply this week. Agriculture was down, natural gas was down, Bitcoin was down. So lots of kind of wreckage here if you were outside of the metals. Now, this is really where we need to take some notice here. Take a look at these charts. These are line charts, of course, now of our treasury yield. So we've got basically, 5 years right here. We've got the 10-year maturity. We've got long-term over here. And if we take a look at our 10-year, look at this line chart just entirely just drop off of a cliff and cascade lower here. So that is showing yields coming down. The 10-year treasury yield going into the weekend now at 3.8%. It's one of the fastest single-day drops, biggest moves, certainly in the ranks in the top percentile of just magnitude of a drop. So that is something to take notice of here. Dollar index fell in lockstep with it, and we're going to talk more about that in just a minute. So let's get into some charts here. We're going to kick it off with the S&P 500. And if we take a look here at the S&P 500, I'm going to clear this off now. And if we look at our weekly chart, we've now got 3 weeks down in a row. And this is looking like a correction, right? We're in a correction, to state the obvious, but like this is now taking shape of a classic sort of correction. Take a look at April, right? Take a look at April. We drew this analogy the last couple of weeks. We looked back at this pullback, and this is exactly what we drew to sort of prepare ourselves, right? To have an open mind and to say, if we got back to the magnitude, if we got a 7-8% pullback like we saw in April, what would it look like? We game planned this a couple of weeks ago. So hopefully, you know, the volatility that we're seeing here, of course, in real time, it's a little more, you know, perhaps scary, but this is what we talked about weeks ago, not as a prediction, but just as an open-minded concept that we could get a multiple week down correction. And here it is. Now notice on the downside here, volume is increasing here with each and every week that's gone by. That's actually, you know, kind of a good thing if you want this to climax here and sort of reverse and get the sellers out of this market. Then you do want to see this volume sort of capitulate and get higher as this moves on. So I like the third week down in a row. We've got now approximately, I could put my indicator on, but we've got approximately 6.5% here in the S&P 500. I mean, it's still, you know, that number still feels like a fair snooze fest here in terms of a true correction number, but hey, it's something. It's finally shaken the tree a little bit, and certainly there are individual stocks that are feeling this tree shake a little bit harder than others. If we go down to the daily chart here of the S&P, because you got to remember that it is still a diverse index, even though it's heavy on the tech side, there are still things like utilities and healthcare and financials that are trying to buoy this thing up. So when we look here at the S&P 500, I like the big volume coming in on Friday. I like the fact that the VIX jumped almost to 30, right? And when I say I like it in terms of trying to get that max fear, that capitulation in the market, right? Not to say we're done and not to say that the coast is clear, but you're getting a good washout here, right, of this correction. Now, a couple of things to note. We first talked about the volume that was, you know, sort of cascading up here. We did come back down and sort of retest the May highs here, or I guess right into this range, the latest breakout of this market. We kind of jumped over this gap a little bit, but we kind of filled this gap. We sort of hopped over it, which is, you know, not quite an island top, but you could probably, you know, you almost get to what that could look like. But you saw some aggressive follow through selling too of Thursday's session. Now, what really transpired this week was basically a nice kind of bear flag, another one similar to what we saw last week, just on a slightly more volatile and bigger scale. We saw this grind up, and then of course with the earnings and the Fed and kind of the 1-2 punch, we basically got this big breakdown and reversal cascade on Thursday, Friday. So when I look at this market, if I throw on Bollinger Bands here, throw on a daily chart, you can see that we are, you know, below the lower Bollinger Bands. It's starting to expand up here. We're getting volume to pick up here. This is feeling more like that short-term capitulation. I don't know if it's done, right? Nobody does, of course. It feels like we're getting closer, but it just, you know, needs more time here, right? As we always say when we start to get into those corrective states, you know, at least let ranges compress a little bit, try and clear over a prior day's highs. You know, if I'm a short-term trader, I'm looking to see, can we get back over this, you know, 53.83 area here in the S&P 500? Can we start to move back into this gap? Can we start to, you know, hold on to a prior day's lows? That's what I'd be looking for, you know, as I sort of come into next week. But clearly, you know, we can see that we are stretched, and we can start to, you know, again, do some shopping on those individual stocks and charts that look a little bit better. If we go to the Nasdaq 100, you really do have more of the same. We're back now into, say, a, let's see, 11.7% pullback correction, and we are back to testing these March, April highs. So if we go back to the weekly chart here, like we talked about a few weeks ago when we were game planning this pullback, we outlined, you know, potentially this correction coming down into retest the highs over here, and that would be still a, you know, it could be in a cyclical sort of bull market. and still have this type of correction. And so now I think folks, when they see it in real time and they see the VIX and they now are starting to get worried about a recession, pushing the buy button becomes perhaps harder, right? And again, I'm not saying that the coast is clear, but this is the pullback that I think lots of folks were waiting for or wanting for. But now that it's here, the question is, what does your trading strategy or your trading plan or your investment process tell you to do? That's really what I think you need to be thinking about this week. We've got about a 12% correction, volumes on the increase here. If I throw on Bollinger Bands, you can see again, we're riding this one down. They are expanding, volumes picking up. So once again, we're at a spot where you would want to see the market now finally start to catch its footing a little bit, kind of level out, right? We'll see if Friday was in fact the capitulation. Nobody really wants to hold into a weekend with a VIX at multi-year highs, with geopolitical uncertainty going on now with Iran and right down the list, recession on the horizon. This looks about as scary as you could concoct for a situation right now for the stock market, hence the 12% correction, hence the panic that we see out there with the volatility environments. So there is absolutely opportunity out here for a trader, but it's really going to come down to time frame and, your personal sort of horizon and all that personal stuff. So here it is, Qs. Right down to about a 12%. This would be a great spot to find buyers. We'll see if they emerge here next week. We'll see if this lift off of the lows here is good enough to sort of solidify a little bit of a low. If we take a look here at the Russell 2000, this most certainly did probably more damage than anyone would want to see that was parked in this space. If we look at the Russell 2000, of course, like we've been tracking, this has been, kind of a breakout, good volume coming in, finally clearing above a range. This is something that we've been excited about, and this absolutely took a lot of wind out of the sails here for the Russell 2000. This gets downgraded in my mind significantly in terms of my excitement about the Russell 2000. I think it's at a fairly do or die kind of spot here around this 210 area. And so next week, I think will be a big week for the Russell 2000. I absolutely liked the volume that was coming in here and the progress that was being made. But now with some of this action that we see this week, I think you really do need to take a second look here and perhaps, pump the brakes on the excitement. Maybe you're reducing risk, you're waiting and seeing, you're kind of letting the dust settle a little bit, but I think it's a change gears kind of moment for the Russell 2000. I don't think I can be as excited about it right now until I see a little bit more evidence here. And that's the way, it needs to be sometimes. And that's why we do these videos every single week, because as the new data comes out, we can adjust our plans accordingly. So Russell 2000, not all hope is out of the way. It is still, again, on the last month, the best place to be in the stock market. But we're going to need to see if this 7% down week is capitulation in itself, or if there's more follow through, reversal, and pain for everyone that just chased this breakout. All right. So Russell 2000, there it is. Nasdaq, S&P, and let's move on. So let's take a quick look here at the VIX, right? The VIX, another thing we did get wrong last week is basically saying like, look, it seems like that could have been the high in the VIX, but not the low in the stock market or in the index. That clearly was not the case. We came roaring above this and breaking out here, surging to almost 30 for the VIX intraday this week. So, or Friday, I should say. So we gapped up on Friday on the VIX, pushed all the way up, and then you could see we settled back down. But if we take a look through history here over the past couple of years, we are certainly at some elevated nosebleed levels. Weekly chart, again, going out at basically the highest level we've seen in the last couple of years. If we go to the Nasdaq vol, it's pretty much the same exact thing. You can see going back multiple years, up almost in the upper 20s for Nasdaq vol. So let's see how the weekend shakes out. Hopefully, fingers crossed, overseas geopolitical stuff stays contained. We can find some type of peaceful, resolute there in the near term, and it does not escalate, markets may come into Monday slightly more sober and can catch their breath. So that is volatility. Let's take a quick look at gold here. So gold, you can see weekly chart, I mean, looks beautiful, up 2% this week. This is, where gold does seem to excel. It's turbulence, it's uncertainty, it's geopolitical uncertainty, it's everything around what will happen this week is what makes gold work in a portfolio, and it did its job this week, and it's had a hell of a year. It's been on a good move, trend is up, and it's a new weekly closing high. So GLD looks good. Let's move on to Bitcoin here. Bitcoin not acting as a safe store of value. This is down pretty sharply this week, 8%, really, taking out last week's lows. So we talked about the fact of Bitcoin dip buyers kind of coming in this last week and driving it back up. There's lots of events going on here. So last Friday when we had our recording, that was basically the big Bitcoin conference. We had presidential candidates speaking there and lots of sort of excitement going into that event and news over the weekend. And of course, now this week, we certainly digested that and we got to really experience the reckoning here of some of the volatility in the stock market. So Bitcoin, I think some of that exuberance and that momentum and that positive fervor got kind of spoiled and sucked out of this market as well. It's back in consolidation mode. Doesn't look like it's on its breakout anytime in the near term. It's going to need some more time to repair here, and you really do have this open gap which you potentially would get filled here. Again, this is the IBIT ETF, and futures market I believe has that open gap as well, given the way that traded. So for Bitcoin here, looks like it's kind of lockstep in with risk assets at this moment. Going to need some more time and digestion. It's in this range. Let's see how things continue. Volume really hasn't gotten too extreme on any of these particular sessions, but certainly 4 or 5 days down in a row here, but back in its old range. Now let's take a quick look here at some earnings. Intel, I think, stealing the show this week. So, this is, I think, its worst day in its history as a public company, which is a very long time. You can see that this stock has really had some tough times here. It's just really hasn't been able to keep pace in this massive semiconductor boom that we've seen in the past couple of years. It's just going in the complete opposite direction here. So sentiment is pretty rotten on this stock at this point, perhaps deservedly so, but clearly a massive earnings miss, and causing lots of pain there. Let's talk about Amazon real quick. Also down almost 9% this week on its earnings report. Let's actually switch over to, I think I got a new Mag 7. Yeah, so if we take a look here at the Mag 7, now that everything has reported, you can see the weekly performance right here. Most things negative. Meta and Apple are the two bright spots here. If we take a look at these charts just down on the bottom here collectively, you can see that most things are just still kind of comfortably in a drawdown. So Microsoft now is basically in a 13% drawdown. Amazon is in an 18-20% drawdown. Tesla now in a 20% drawdown. Google in a 13% drawdown. So it's Meta that is trying to buck the trend a little bit, and Apple, which is only in a 7% drawdown for Apple. So you've got all the earnings out of the way now. You've heard everything you needed to hear. NVIDIA is still a late report, so we still won't get that until the end of this month. But, the market, I think generally, numbers wise, things were pretty good across most of these companies. There's just a lot of expectations built in, and certainly price appreciation going into these events. And I think that was honestly, some of the biggest disconnect there was just that these stocks have run so well going into these numbers. So that, I think, covers everything I wanted to talk about. Anytime we get volatility up at these levels, there's definitely opportunity. There's dispersion happening across the stock market. You're getting repricing of individual securities, and there's opportunity out there, but you've got to follow your trading strategy, your investment plan, whatever that is. You need to ask yourself, what is your A+ setup? Is this the environment for you? Should you be starting to nibble on some of this exposure here? I personally like these periods. So I was doing some buying on Fridays when I basically started to do some buying in some things that I've been waiting for just bigger pullbacks in. That's my style. That's my longer term sort of personal approach of accumulating into dips and weakness. That's not everyone's favor. So it's probably a more advanced, or it's a harder strategy to buy on weakness and to be able to average into something over time versus waiting for stabilization and waiting for the market to make that turn back up and waiting for that momentum to return back to the upside. So if that's your cup of tea, is waiting for momentum and things to settle down, the VIX to cool off, then by all means, take a couple of extra trading days off and go hit the beach while the weather's good. Come back maybe in a week or two and maybe things will be settled down and maybe even you get some better prices, right? So you got to ask yourself, what kind of trader are you? And that's my end rant there on preaching to the traders. So hopefully this video was helpful. Hopefully you made it through okay. Turbulent times. Don't beat yourself up too hard if you lost some cash today. I think most of us, or this week, did. So that's okay. Enjoy the weekend. Thanks so much for tuning in. We'll see you back here next Friday. Take care and have a good one.